The most recent statement of profit or loss and other comprehensive income of statement of financial position of TJ Engineering Limited are as follows. So we've been given the statement of profit or loss, another comprehensive income, and statement of financial position. So scrolling down, the first part here, it says state the correct formula for the following ratios. So all we need to do here is write in the ratios. So again, they do get a little bit repetitive, these, but it is the best way of learning them. So for the current ratio, it's simply your current assets divided by current liabilities. The quick ratio is very similar. It's testing a very similar thing, but we need to remove inventory from current assets. And then the inventory holding period is simply our inventory over cost of sales times 365. Okay, any of the ratios where you're being shown them in days, you'll need to multiply by 365. Gearing ratio, I think we know this one now. So this is debt over debt plus equity. But remember, you're using your non-current liabilities for that, for your debt. Plus equity. Return on shareholder funds then is simply the profit after tax divided by total equity. And then lastly, inventory turnover is cost of sales over inventories. So now that we've got those ratios in, it says calculate the following ratios to 2 decimal places. So all we need to do is take the figures from our statement of financial position and statement of profit or loss, put them into our formulas, and that will give us our ratios. So we'll start off with the current ratio. So for the current ratio, we've said already that it's current assets over current liabilities. So what we need to do is go back up to our P&L and statement of financial position. And we can see here that we've got current assets. Try again. Current assets and current liabilities. So if we add those figures together for the current liabilities and then take our current assets figure of 3563 up here, we'll just scroll down. So that would end up being, for the current ratio, 3563 over 3084. What we'll do is we'll just number these so we know what we're referring to as well. So 1. So that gives us a ratio of 1.16. 2 then is the quick ratio or acid test. So going back up. So this time we want to be taking our current assets figure, but not including inventories. So it would just be our trade receivables and cash equivalents divided by our current liabilities. Therefore, it will be 2,110 divided by 3,084, which gives us a quick ratio or acid test of 0.68, which is quite low. Anything below 1 is definitely seen as a risk. Right, on to the inventory holding period then. So we've said this is inventory over cost of sales times 365. So we want to be taking again our inventories figure up here. And then dividing it by our cost of sales figure over here. And then multiplying it by 365. So that would be 1453 277 times 365 to give us 47.03 days. It does want these, it states in the question, to 2 decimal places. So we would show that as 47.03. Gearing ratio then. So it's your non-current liabilities, which in this case will be your bank loans, over your, again, bank loan figure again, but plus equity, which is stated here. So that would therefore be 3525 over 8322 plus 3525 times 100, which gives us a gearing ratio of 29.75. Number 5 is our return on shareholder funds. So this is your profit after tax over total equity. So it would be profit after tax, which is your profit from continuing operations, over your equity figure that we've just used of 8322. So it would therefore 4910 over 8322 times by 100 equals 59. And then the last one on the list is inventory turnover, which you said is cost of sales over inventory. So we want to be using, again, cost of sales, and we want to be using our inventory figure. So it would be 11277 over 1453 equals 7.76. which finishes task 3. Now move down to task 4. So again, we've been given a statement of profit or loss and other comprehensive income and the statement of financial position. It says state the correct formula for the following ratios, and then again we just need to calculate them. So for return on capital employed, it will be operating profit over capital employed times 100. Inventory holding days, inventory over cost of sales times 365. Trade receivables collection period is trade receivables over revenue times 365. Trade payables is trade payables over cost of sales times 365. And then the working capital is your previous 3. So it would be inventory days plus receivables days minus payable days. And then lastly, asset turnover using non-current assets would be revenue over non-current assets. So similar to what we did before now, we just need to plug the figures in and that will get us our ratio answers. So, return on capital employed, we said is operating profit over capital employed. We remember that capital employed is equity plus non-current liabilities. So it would be 21914 plus non-current liabilities, which are your bank loans. And then we've got our operating profit just over here. It would therefore be 415784 divided by equity plus non-current liabilities times 100 to give you capital return on capital employed of 18.71. Inventory holding period in days then. So again, scrolling back up, you see that it's inventory over cost of sales times 365. So we want to be taking inventory and we want to be taking cost of sales. It will therefore be 3939 over 20,100 times 365 to give you inventory holding days of 71.53. Trade receivables collection period then in days again. So scroll up, should be the trade receivables over revenue times 365. So it would be your trade receivables figure over your revenue figure from the P&L. So it would be 3098 divided by 32500 times 365. To give you a trade receivables collection period of 34.79 days. Trade payables collection period then. So just going back to the formula, would be trade payables over cost of sales times 365. So it would be your trade payables figure over your cost of sales figure from your P&L. So you put those figures in, it will be 3543 over 20,100 times 365. To give you a trade payables collection period of 64.34 days. The working capital cycle then would be the inventory holding days plus the receivables days less payable days. So it would therefore be 71.53 plus 34.79 minus 64.34 to give us a working capital cycle of 41.98 days. And then last on the list is asset turnover using non-current assets. So this will be revenue over non-current assets. So we want to be taking our revenue figure, so 32,500, and our non-current assets figure, which is at the top of our statement of financial position. So if you plug those figures in, it'll be 32,500 over 22,625, which would give us an asset turnover of 1.44. Which we can enter in. So that covers task 4. We can now move on to task 5. So it states that JCD Limited manufacture machinery used in the construction industry. You have been asked to use the extract of the financial statements of the company's main competitor and compare the results. So we've already got some figures in for JCD Limited. We just want to now calculate these for the competitor. Okay, so these are the standard calculations that we've used before. So there is nothing new on here. So it's the gross. If we just scroll down, we've got the gross profit percentage, operating profit percentage, return on capital employed, current assets, acid test, etc. So there is nothing new in terms of formulas that I've not been through here. So what I'm going to do is I will input the percentages or days for the competitor down here, and then we will have a look at the comparisons that we need to make based upon part B of this question. So the results for the competitor are as follows. So we've got 63.2% gross profit margin. We've got a 12.6 operating percentage margin. We've got return on capital employed of 10.1. We have a current ratio of 2.1 to 1. We've got an acid test of 1.1 to 1. We have inventory holding days of 106 days. Trade receivable days of 44. And then remember to calculate your working capital cycle. It would be the inventory holding days plus trade receivables less trade payables payment period, giving us 67 days. So now that we've got those in, let's have a look at the following statements and decide what out of the options are true. So it says, based on the scorecard above, select the correct assumptions for the following.
Hi there, and thank you for watching the video. If you're new here and passionate about everything accounting, then don't forget to subscribe and give us a follow. We're proud to deliver the best standard of support to our students. We have bespoke study materials, exclusive AAT unit videos, award-winning tutors, and so much more. Make sure to follow us on our social platforms to stay up to date with what we're working on. Thank you.